Hello, and welcome back. I wanted to make a video and talk about Michael Burry and his recent bet. He went short, basically short of the stock market and the QQQ, that's the tech industry pretty much for the most part, and the Nasdaq. And so there have been articles talking about how Michael Burry bet $1.6 billion, and people can be misled by that, thinking that he actually bet 1.6 billion against the market, and that's not what happened. It's not even close to the amount of money that he bet for these put options that he bought. And there is a misunderstanding here which I wanted to explain. And I will start by taking a little bit of a look at stockcircle.com, in which actually shows us his put options. So he bought 2 million shares, actually that's put options, of S&P 500 and QQQ. Now the way this works, each put contract is about 100 shares. So what you should be doing is getting the 2 million shares and divide it by 100, in which case you will be getting 20,000 pretty much put contracts of the S&P 500 that he bought, and 20,000 QQQ contracts that he bought. And the 1.6 billion that you get out of these articles is about the multiplication of the amount of shares here, the amount of shares like 2 million to $420 and 2 million to 336. But this is not how much Michael Burry will be making out of this trade, neither how much he actually paid for this trade. It doesn't work like this, and I will explain how it works. But it's worth noting at first that it's not how much he bet, and it's not how much he will be making. That's very, very important to know. And you will see again on this one that he bet 1.6 billion, which is misleading. Now, this article here, for instance, talks about how no, Michael Burry didn't risk 93% of his portfolio on put options, neither did he risk like $1.6 billion, because that's not how it works. And yeah, you'll see it all over the place that he bets all this money, like the market value. That's the market value, that's not the nominal value, as we call it. It's basically just the multiplication of the shares, but this is not how put options work. And the way put options work, and I will help you understand this, put option is basically a contract in which, remember, we always have a buyer and a seller. And a seller is selling this contract, and the buyer, when they buy this contract, they have the option of selling shares of a company, or in this case the QQQ, for instance, or the S&P 500, back to the owner of the contract, the seller of the contract. And there is a strike price, and this strike price is how much they will be selling it for. So think about it this way. Let's just say that we have a stock, any random stock, let's just say Apple, and that is selling $10 today. That's the current market value of the stock. And so somebody is selling put options, and they are telling the potential buyer that they're willing to be buying this stock for $8 within a month, for example. And they're selling a contract for this. This is called the put option. Now, who would buy that? Why would you buy the option to sell a stock back to somebody for $8 when it's 10 today? You would be buying that in the case where you think that the stock would plummet in the upcoming month, for example, depending on where the contract expires. And so if the stock goes down to $5, you would be buying it for $5 in the open market and exercise your put options to be selling that back to the seller of the contract for $8. And remember, 1 month from now, the stock would be at $5, pretty much crashing. But now you can still sell it for $8, making $3 of profit, minus the amount that you paid for buying the contract. And this is how this works. And so as you can understand, again, if we go back here, this is, remember, 20,000 contracts here. So this is 20,000 put options, pretty much, that Burry bought for the S&P 500. And so if the strike price was, let's just say, at $400 over here, and the S&P 500, let's just say a month from now, goes down to $300, then this difference is going to be the amount of money that Burry would be making. So $300 would be the price if the stock market crashes and the S&P 500 crashes, but then he can still sell it back for the strike price, which was $400, and in the process making $400. Now, for the privilege of buying these contracts, the buyer would be paying some money, but it's going to be much, much less than the actual price. So it could be like 50 cents or maybe $1 per share, that is. And so you multiply that again by 100 because its option is its contract is for 100 shares. So if it's a dollar, then multiplied by 100, you will be paying like $100 for the option, for a single option here. So this is how that would work. But in the process, you could be making 100 times that amount, right? So you paid $100 for 100 shares just because a single option is like a single share for the option is like $1, but then you are making $100 if it goes down to $300 over here, and so this is 100 times more in terms of profit. And so this is what he's betting he's betting for, and he's expecting the stock market to pretty much crash in regards to the S&P 500 and the Nasdaq, which has been pretty much doing really well in the past few months. And again, this is the misleading fact that we're seeing here, that the fact that he bought 1.6 billion is not exactly how this works. And this article actually puts this into the exact amounts over here, for instance. And you will see that these options, for instance, here, they are trading for $8. Not one that I mentioned earlier, this was an example, but $8 makes a ton of sense. And this amount, the amount of that the option is worth, is mainly based on two things, the expiration date and the strike price. Because if you have an expiration date that is far into the future, then you have more time for this option to go through, right, as a buyer. And so it's worth more to you. And so it's more expensive, as you can understand. And also the strike price, if the strike price is closer to the actual price today, then again, you're going to be paying more because it's easier to happen. It's easier to go down from that price. So that's how it works. It's pretty simple, but it's also pretty complex as well in regards to the mathematics. And you can open up a put options chain and see how this works exactly and what kind of prices you get. Maybe I will make a separate video, but this is how it works here. So you will see that $20,000 contracts here for of each. You will be paying like $1 million in this situation over here. And so you can understand by doing the multiplication that he probably paid, that's Burry, maybe like 20 to 40 million. We don't know exactly because we don't know all the details about the expiration, for example, and the strike price. But this is about how much he would be paying, which is way lower than 1.6 billion, again, what I mentioned earlier. So it's important to understand these things and not just get dug into the headlines and what people are talking about. And so this article here is talking about how this big short on the stock market is likely too aggressive, but it could also be a hedge against other bullish positions. And remember, we're getting a delayed reaction, like this 13F filings that we get for instance, Michael Burry are delayed, so he may have actually moved ahead, and we could be getting what he could potentially have bought maybe in the next filing. And so these things change rapidly, and he could have also, as I mentioned earlier, used these options as a hedge against the potential blow in the markets, because we do have some negative sentiment in the stock market. Like, for instance, there are some things happening. Foreign investors fleeing China's stock markets at record pace, as there is a wipeout, and you will see that we have been selling an aggregate of 10.7 billion of Chinese stocks in 13 consecutive trading sessions lately. That's like a week ago. And so there has been some liquidation here in China, which has been concerning for sure. And also the fact, for instance, that Fitch has warned that it may be forced to downgrade dozens of banks, including JP Morgan Chase. And as you can understand, if this happens, this is a huge bank, this will cause a chain reaction in the stock market, and other banks are going to be downgraded as well. Interest rates will go much higher. We will have the same bond issues potentially with many banks as well that we had with the banks that have crashed in our recent past. And so you can understand that this scenario could play out to a potential havoc among the stock market. And this could be one of the reasons why he actually decided to go against the market, or at least bet some of his money. It's a sizable portion. Again, it's a few $1 million, nothing to sneeze at, definitely. But it's nowhere near the 1.6 billion that has been discussed. And I wanted to clarify that by making this video. I hope you watched it through. Let me know if you have any questions below. Leave a comment below. I'd love to help. And again, I may be making some more detailed videos about how options work in the future, because they can be a little bit complex. Thanks for watching, and I'll see you soon. Bye-bye.